My name's Errol Zeki, and I'm the Chief Executive Officer at Sasfin Wealth. So, on behalf of David Shapiro, Nicholas Dakin, and the rest of the Sasfin team, I'd like to welcome you to this live webinar. It really has been a roller coaster ride for local and international markets. I think, amazingly, as of Friday's close, the S&P 500 index in the US is down a mere 1.4% year to date. If you move locally, JSE is down around 1.8% for the year, and the top 40 index, I think, at the moment is actually marginally up. So this all sounds quite palatable, given the moment that the world is in. But if one starts to break this down, however, both locally and internationally, and take a broader view of the market, paints a very different picture. The recovery in the US has been very dominated by large tech plays, and locally, what's commonly referred to as SA Inc., so your property shares, general retailers, financials, etc., or paint a very different picture. They're very different levels and well below where they were pre-COVID. So the index strength has really been dominated locally by a few heavyweights like Naspers and Process, and given their holding in Tencent, they behave more like a large international tech company than an SA Inc. And gold shares and a few other bits and pieces. So in today's webinar, we're going to try and make sense of it all and discuss the prospects for equity markets going forward. During the presentation, if you have any questions, please post them to the chat function. We will do our best to identify and combine the most common questions and respond to as many of them as we can after the formal part of the session. Presenting today, we have David Shapiro and Nicholas Dakin. David is the Deputy Chairman of Sasfin Securities and celebrated 50 years of working last year. So that's 50 years of direct market and financial experience. And then Nick is a Senior Portfolio Manager in our Cape Town team. He's also a member of the investment team that manages the Sasfin Global Equity Fund. So thank you, gents. We look forward to your insights, and over to you.
So, Errol, I'm just going to expand a bit on what you've said in terms of what's driven this recovery in the markets. So the first graph here compares the performance of the JSE versus global markets so far this year. And the recovery in the JSE has followed the global recovery very closely. The US market reached a record high on the 19th of February, and by the 23rd of March, the market had dropped over 30%. The decline in markets was followed by the best 50-day rally in the history of the S&P 500. The pandemic and countries' responses to it has been the key determinant of market performance so far this year, and this is likely to remain the case going into the second half. In terms of the outbreak, if you put the world into 5 stages, we have the reaccelerating stage, which is the US and Japan. Flat plateau is Russia and Iran. Still accelerating, we have Brazil, Chile, Mexico, India, and of course, South Africa. The first wave is under control in most European countries. And then finally, we have the prevent second wave stage, which is China, Korea, Singapore, as well as Hong Kong. The graph on this slide is the same as the previous one, except it's in Rand terms. The reason I included it is to show that as a South African investor, you've actually done quite well since the start of the year if your money was offshore, given the 20% odd depreciation in the Rand so far this year. So why have global markets rebounded so strongly? Well, the first reason is that central banks are providing extraordinary levels of liquidity. Equity market performance is highly correlated with the level of liquidity. Simply put, the response by central banks and governments has been unprecedented in terms of speed and scale. The US Federal Reserve has nearly doubled the size of its balance sheet to $7 trillion in just 3 months, and the stimulus will continue. The second point is that economies are reopening and activity is picking up, albeit far below previous levels. We also have the rise of the retail millennial investor, which has also boosted the market. Without any sporting events to watch, younger investors have started playing the stock market for entertainment. Robinhood, which is a very popular trading app in the US, has seen a massive surge in users as well as trading activity, with millions of new accounts being opened. The average user is just 31 years old. And then finally, the promise of a vaccine. It's very difficult to keep track of everything that's happening in this regard. And it's also incredibly difficult to know if and when a vaccine will become available. So far, Gilead's antiviral remdesivir looks quite promising. The company said on Friday that a new analysis suggests that the drug was associated with a 62% reduction in deaths in patients with severe COVID-19. Another promising one is BioNTech, which is a German biotech firm that has a partnership with Pfizer to develop a coronavirus vaccine. The company is confident that it will be ready to seek regulatory approval by the end of the year. And then I also saw over the weekend that there's also some new evidence that an upper arm shot using the blood of a COVID-19 survivor could inoculate people against the virus for months. It's important to note that the magnitude of the market recovery has varied very widely by region. As Errol said, the US has led the way. The S&P 500 is basically flat this year. The JSE has fared relatively better than most other regions, and I'll explain why this is the case in a bit. Developed markets have done better than emerging markets. And then at the bottom, we have Europe and the UK, which have lagged considerably. And there are a few reasons for this. The first is that both regions are heavily reliant on global trade. And the second is that these markets contain a large number of financial, energy, and industrial stocks, which have been the hardest hit. And you can see that in this slide, which shows the year-to-date performance of the various global sectors. The magnitude of the market recovery has also varied very widely by global sector or industry. Companies in the hospitality and travel sectors have suffered disproportionately, while others exposed to the stay-at-home economy like e-commerce and online payment systems in the fintech sector have continued to grow very strongly. The tech sector has therefore been the star performer this year, which is why the Nasdaq is trading at all-time highs. Energy stocks have been amongst the worst performers this year. Oil prices were hit by a perfect storm of a supply glut as the OPEC plus production agreement broke down, and then demand also fell off a cliff as the global economy went into lockdown. Brent crude dropped from around $66 a barrel at the beginning of the year to below $20 a barrel in April. The price has recovered as economic activity has started to normalize, but is still down very sharply this year. Financials have also been hit badly. With interest rates falling, it is more difficult for banks to make money as it reduces their lending margins. Also, there will be a massive increase in defaults and impairments because of the virus outbreak. This slide shows the performance of the JSE sectors year to date, and the divergence in industry performance has also been very evident on the JSE. As I said, the JSE is almost flat this year, and one might think that it's actually done quite well on that basis, but this figure is a bit misleading. Nearly 80% of the shares in the all share are down this year, and the average share price decline is around 20% compared to around 10% for the S&P 500 in the US. Banks, property, and industrial stocks are all down around 40% and have continued on their downward path, which started long before COVID. The pain has also been particularly felt in the smaller companies on the JSE, which are still down around 25% year to date as a whole. The reason why the JSE has actually done all right is almost entirely because of one share and one industry, namely Naspers or Prosus, as well as gold mining. Naspers has been a key beneficiary of the stay-at-home trend. Its large exposure to Tencent has done exceptionally well as people have taken to gaming while being kept indoors during the pandemic. Also, its food delivery operations have seen a massive increase in demand. Rand hedge stocks have also held up okay due to the weaker rand. For example, British American Tobacco, which is up around 14% year to date. However, it's the gold miners that have been the standout performers, benefiting from the stronger gold price. The key message in all of this is that if your portfolio was positioned in the right areas, be it region, industry, or share, you would have actually done quite well so far this year. With that being said, I'll now hand over to David, who will discuss where we believe your portfolio should be positioned going forward.
Thanks very much for that, for all the detail and for the slides. Now, just for those who've been watching Nick, he is a millennial investor. He's only about 22, 23, I don't know. He just started shaving, and he had to borrow his dad's jersey for this performance there. Normally you'll find him in his pajamas, but Nick has singularly been responsible for the huge gains that we've seen in Tesla and Zoom as Mr. Millennial on Robinhood. Anyway, I'm absolutely knocked out by how fast the markets have recovered. I know Nick's explained things. He's gone through the various shares. And of course, the big question is where are we going to from here as well? The fact that the markets have recovered in the midst of some very, very difficult circumstances and trying circumstances is a very positive sign. And from my point of view, don't ignore the signs. The signs, the signs that we are making headway and going up, for me is a strong indication of the fact that we will see things getting better from here and markets will continue to climb. And having dealt with clients for so long, for so many years, what you find, and it's wonderful to understand the psychology, because I know that most of the people watching are saying, no, it's going to come down. No, I'm not going to buy this. It's got to come down. When it comes down, I'll buy it. And that's exactly what happens. And when it does go down, or if it does go down and starts falling and you say, you're going to buy now, they say, no, it's got to go lower. It's got to go lower. So we're in that stage. We're in that point where I still feel, fairly confident about the kind of trend that we're seeing now. What's important, though, is that we are going into the reporting season. And I think one of the reasons we're seeing a pickup in the markets today, and I'm just looking at the S&P, the futures look like they're going to go through 3,200 level. We've been there before in the last couple of weeks, but it does look like we're going to go there, and a lot has to do with the upcoming reporting season. And I think what's important is that we're going to start off with banks. There will be one or two tech companies that come through, but what it is going to highlight is just how companies have held on or have done in this in the lockdown. From the banking point of view, I think the banks like Goldman Sachs and Morgan Stanley, which do not have private customers or do not have are more inclined to look at institutions, so they're not really exposed to retail. I think from their point of view, you're going to find there were a lot of debt issuances on which they made fee, and also trading, probably more so than JP Morgan and other banks, Wells and that, which could be hurt. But the important thing, and it also comes particularly from tech shares, we're going to see how they accommodated themselves during this period. And I think Netflix as well. How many more people did they add? So very important coming through. Just very broadly, Nick did cover the macro level in that, and I think what I find interesting about where we are now is we're beginning to adapt. We're a resilient people, and I think people are beginning to adapt to the kind of circumstances under which we find ourselves, and that's important. It's important because, particularly in the light of second waves and other negative stories that we're hearing, if we can get through this and believe that it's going to go, I think it's going to keep markets on the way up. But just think about how our lives have changed. Okay, so we're not ordering sushi at restaurants. Instead, we're eating sausages and eggs. just think, a night out, Nick mentioned Uber Eats and that. So what's a night out now? We order from Uber Eats. And, when the Premier League came on to television, we said, we can't watch this. There's no crowds. The players are not committed. Well, we are watching it now, quite enjoying it. And not only that, the players seem committed. As soon as they score a goal, they all run to the corner, start doing dances and kiss themselves. Forget about social distancing. It doesn't happen at the end of the games. They're all hugging each other and so on. So we are adapting. And another thing, we're quite comfortable in tracksuits and slippers and wearing. This is only for show for the seminar. Just back to the global economy. On the positive side, Nick mentioned the amount of stimulus that has been put into the market. And I think this indiscriminate level has actually worked. And we're starting to see it in the results. We're starting to see signs of economic activity, signs of recovery. Even if they are tentative, they're still pointing in the right direction. We've seen the US consumer spending, particularly in e-commerce. Credit card sales are up, or credit card numbers are up pretty well. Housing numbers have surprised us on the upside. Employment is stronger than the market was expecting. Of course, there are always the naysayers and wait until next month, it's going to start coming down. And, there are a whole lot of issues as well. And even in the sentiment indicators like manufacturing and other consumer indicators, things are picking up and surprising on the upside. If you look at Germany and South Korea, they're heading for a V-shaped recovery. And one of the reasons is that they're manufacturing business. They're a manufacturing economy. So you haven't got the close contact that you would find in Mexico, where they rely on the leisure industry. They rely on hospitality. In Germany and South Korea, in factories, people are distancing from themselves. They're not not necessarily service economies. And most of the factories there are automatic in any case, robotic, so you don't have a lot of contact as well. So they're getting through this in a good way, and of course heading for what is a V-shaped recovery. And apparently I think Denmark and Norway also probably returning to normal. So we've seen some very positive signs there. Of course, it's still very fragile. We're still worried about a lot of things. We're worried about second waves. Also, householders are scared to go out there and really spend. They're saving a lot. They're not sure where, when they do return to work, or if they have returned to work, how reliable it's going to be, how sustainable it's going to be as well. My big worry is that the longer these delays take place, the longer that this happens, the more concerned we are for industries like airline, more concerned about the leisure industry, and also about those people who are on furlough, as they call it in the United States, which means on temporary leave, whether they will be employed, when they get back. And the other point is on governments, how long can they continue to spend? I know that Jay Powell and most central bankers, believe they can continue for some time. But, already we know that that America's going to discontinue the $600 unemployment benefit from the end of the month, believing that this is actually stopping people from returning to work. But big concern about how long we can continue, or how long governments can continue, pushing the economies up. And on top of this, as well, other concerns are the cross currents that we're seeing. The US continues to go at China. Europe is going at China as well. There are worries about the future of Hong Kong as a financial center. We're into the US election. It's going to be a lot of rhetoric around that. My view is that I don't think Trump's given up on the pandemic. I think he's giving up on the US economy. I think all that concerns him now is trying to fight the election and trying to win a second term. And with that comes his vitriolic and hate speech. So we've got to get through. We've got to get through these issues as well. Just anybody who has been in the market a long time knows that we've had incidences like this before. They've come around, they're very stressful, and they all have different characteristics. But we have to understand this position. We will get through it. We know we're going to get through it. There will be a vaccine. There will be cures. It's just a matter of time. But I think the one thing about this particular crisis, and I suppose it applies to all other crises as well, is that things will change. We are going to see changes. And therefore, when we go into the market, we've got to start looking at how companies are going to adapt their business models to the changing circumstances. What are going to be the new drivers of business, and what's going to destroy the older ones. I think we will see an economic reset. Capital is going to move from those companies capital is going to move to those companies that are doing well, and they're going to move from those companies who are not doing so well. It's going to be an evolutionary process, and we've got to watch that, and that's where our positioning is important, and that's what we're going through at the moment. We're starting to focus on those industries that were going to prosper in the next 3 to 5 years, and move away from companies that we think will be hurt. And those companies that we're moving away from are actually big legacy names. But one's got to start thinking ahead. I think companies themselves are going to have to adapt. And even though at this stage they're all in the survival mode, they're looking at their balance sheets, preserving capital, cutting costs, very concerned about where they are. Sooner or later, they're going to have to change and adapt to what the new circumstances are going to be. Look at their supply chains, and look at what their core businesses, and even look at their processes. Do we need these processes? Do we still need to do salaries or payroll? Do we still need to be responsible for our own computing and that? And all issues like this. So I think that's going to come. One of the biggest issues, or one of the biggest change, or biggest positive change that we've seen over the last 3 to 4 months, is that we have learned to do what we didn't know how to do previously. And I think that's a major step. That's both for the consumers and customers. So businesses have actually benefited from that point of view. Transitions in teaching their customers or teaching their staff how to do things that would have taken decades have actually taken only months. And I think that's very important. So what might have been a barrier for businesses, a barrier to entry, is now actually a new standard. Although, to be honest, it also allows new entrants to come in as well. So what we accepted as being only temporary a solution during lockdown is actually going to become important. The fact that we're now on a Zoom, the fact that we're working from home, the adoption of cloud, new supply chains, new distribution channels, new global alliances, and that, all of those are taking place now, which we thought would have taken a long time. So there's still a lot, even though I'm talking in a confident level, there's still issues that worry us. I think there's still worries about, about people who are going to be unwilling to fly, people who are willing to go to restaurants, people are worried about living in city. Those are still issues that are going to linger for a lot longer. And I think only until we find a vaccine will we be able to overcome those issues. But in the meantime, still a lot is happening. Just it's enough about the big picture, I know, and just more on where do we position ourselves. Well, I have to tell you that I'm a 100% equity man. I believe even in these positions now that we find ourselves, I believe in the creativity of man. There's this incredible urge that they have to find new solutions to issues, and discover new ways of doing things. And that's why I always like equities, because it's the kind of character that builds companies. I don't understand property. I've never been a property man. I've always been, property, people build buildings during booms, as we've seen now. then comes a crash, and those people who built the buildings in boom have to wait for the next boom so that they can fully let them. So, I've never been enticed to go into property. And then we have the bond traders. I'm not a bond man. They only smile when the global economy is falling into a big hole. Why? Because interest rates come down and they make money on the capital side of their issues as well. So, at the moment, can you believe the bond people? They're dealing in securities that have got a negative value, and they get very excited if bonds change by a decimal point, and they can talk for hours and hours, on things that change to the fourth decimal point. So as I said, I've got great respect for entrepreneurs and business leaders. And the one thing about business leaders, they don't read the headlines. They don't wake up in the morning, turn on CNN and try, see what the death count is and how many people died and where the outbreaks are. They think in a different, completely different atmosphere. And, I was reading yesterday about Marco Polo, and it's quite interesting. And I kept thinking about Marco Polo, and I thought, what happened if Marco Polo had read the Mongolian Times, and read about Kublai Khan's conquests and his murders and the various wars that he would never have embarked on the Silk Road to try and open up new trading channels, to the east. Admittedly, he was an adventurer, and those channels only opened later. But he did probably invent or give birth to the term of globalization, going to find new areas of trade. And of course, following him was Vasco da Gama and Bartholomew Dias and Christopher Columbus, although most of those people are now vilified and we shouldn't be mentioning their names. So anyway, that's why I stick to equities. If anything, the lockdown and pandemic has accelerated trends that were already in place. So we must understand that there was already this transition taking place that has now been accelerated by what's happening, in the current lockdown and because of the pandemic. The fourth industrial revolution is just beginning, but it was beginning before lockdown, and all that's happening now is that this is going to accelerate. So the point is, don't ignore these trends. Don't ignore the transition that was already in place has now been accelerated. What's happening is that there might be just a temporary obstacle. I don't think so. I think that this has just given it a big boost. And another point I always make, when talking about the equity market, and it applies particularly now, is that just think of the rich list. Just think of what you would have made or what you could have made by investing in the world's richest people. If we look at Jeff Bezos, he's now worth 113 billion odd. Well, that's at last count as well. He started in the garage in 1994, trying to get people to read books electronically, etc. And he was mainly on that side of it. But that business has developed to an incredible extent, where it's today a massive multi-billion, I think, at over $1 trillion. And along that journey from Jeff Bezos, investors always said, no, too expensive. Nah, he's not making profit. Whatever profit he makes, he just keeps on reinvesting and so on. And that's been the trend. But just think, if you would have invested in Bezos, think about Zuckerberg as well. He's actually come in number 3, because number 2 is still Bill Gates at about 98 billion. But he has a kid of 36 worth 78 or 79 billion dollars. I know we don't like him. I know that we love to go at him because of Facebook. He's constantly, being not vilified, being criticized, etc., because of his failure now to censor certain divisive content that was on his site. But hold on a sec. He started this business at the age of 19. He didn't go out. He never knew where it was going to go. He created something that we picked up. And over the last couple of weeks, etc., we've heard, Unilever not going to advertise on Facebook, Coca-Cola, you name them, Starbucks, all these big businesses are pulling out. Well, let me just tell you something. they hardly matter in Facebook's lives. They're very, very small proportion of the advertising. Who are the big advertisers? Those small businesses who could not or would not advertise without Facebook. And it's given small and medium businesses access to an incredible market, to billions of consumers who can see the advertising. So it's opened up a whole new world. And that's one of the reasons that I'm very nervous of businesses, of the older businesses, because in the past, and I'm using Unilever only as an example, Unilever would advertise or would dominate space on the large networks, NBC, ABC, companies like that. And they had the power, they had the marketing power to make their brand felt. Well, with Facebook, with Google, with Instagram, with all, Twitter, you name it, suddenly even small companies have the same branding and marketing power as well. And that's where Facebook has made its mark, and that's where you're going to find consumers now having much, much greater choices and putting pressure on the margins that these big brands used to have. So I don't know Zuckerberg personally. To me, he's a bit of a sour person, but you can't ignore the power that companies like Facebook have. So, after Zuckerberg, Buffett's now fallen down mainly because he's given money away and also his share hasn't performed. But after Zuckerberg, we have LVMA's Bernard Arnault, and then comes Buffett, Larry Ellison, and also a very important man, Amancio, I hope I'm pronouncing it right, Ortega, who also transformed the retail industry with his with these Inditex, as we call it, but it's big brands there, Zara. So what happens if you would have invested in Amazon 5 years ago? Well, you'll be up in the region of about 600%. Microsoft, 380%. Facebook, 180%. That's in 5 years. And LVMH about 160-odd%. And I'm talking dollars, I'm not talking rands. So an enormous amount of return you would have made. So the point I'm making is, as we go into the fourth industrial revolution, as we go into these changes that we're seeing, the opportunities to invest in these kind of businesses will start to emerge. I just want to say something about them as well. Steve Jobs never started the iPhone because someone said to him, I think we need an iPhone. I think we need a remote. Our lives need a remote to control. We need a remote to control our lives, etc. They created something. He created something. And from that, he created a whole new industry as well. And I think the same applies to Zuckerberg. The same applies to Amancio Ortega with Zara. He changed the whole way that retail, clothing retail takes place, and that's what we look for as well. We look for in the industrialists and the people who are changing the way that we do things. I think Elon Musk is also another one of these characters. So don't lose the opportunity in this market. Don't be scared of what lies ahead. We're in a very, very exciting phase. And the areas. I don't want to repeat them. These are the kind of areas that we're looking at, from 5G to cloud, to big data, to AI, to artificial intelligence, to e-commerce, to gaming, streaming, 3D printing, drones, you name it, digital payments. All of these sectors have got their appeal. The other areas that are going to also start emerging, fuel cells. If you want an electric car, you've got to have good batteries. I think this is where Musk is starting to move ahead. Cybersecurity, once you use 5G and you go onto the cloud, cybersecurity, the actual use of data. We got companies there that are teaching businesses how to use the data, and of course the new thing, quantum computing, which I can't understand. I've got a 1970s head, which is I still work on floppy disks and that, so I haven't got the kind of brain that can that can manage all this kind of data. Also you're going to find tech in all different companies, all different areas as well, such as agriculture, where you're going to improve food yields and so on as well. So it's a vast expanse of of opportunities that are starting to emerge. We've got our normal companies. We as a firm, everybody's got their favorites. I'm going to rattle off a few that we like, from Accenture to Adobe to Alibaba to Alphabet to Apple to ASML, Facebook, Microsoft, Nvidia, Salesforce, Visa, MasterCard, Tencent, and Process. So those are the kind of companies we're investing in. That's not an all-embracing list. There are other areas of the market that we're going into as well. I'm going to move on quickly from tech, but go into another area of the market that you can't ignore. And this is my pet gripe, and that's the health side of it as well. The one thing, and for those of you who've listened to my previous webcast, I brought it up as well. The one thing that you can't ignore is how governments have handled the whole pandemic. And I'm talking global governments, not necessarily South Africa as well. They were completely caught off guard, completely by surprise. And even so, I think there's been, the whole approach has been incoherent. I think led by America as well, but they're not the only villain. The fact that there's been no global meeting or meeting of global heads to sit down and work out how they're going to approach this pandemic still amazes me. And I can't believe that they were caught like this. The only thing I can believe is that no country will be caught like this again, or no one wants to be caught like this again. I don't think any health authority wants to be caught, whether it's a country, whether it's a province, whether it's a municipality, where their hospitals are not equipped to handle something like this, that there are not enough ICU units, there's not enough equipment, there are not enough nurses, there are not enough scientists, there are not enough healthcare workers, that they weren't in a position to handle this, despite a number of warnings. And that raises another huge area of investment that we're going to see, which is going to be into the healthcare system. Simply that no one wants to be caught like this again. And hospitals or public health is going to ensure that they're in a position to overcome or to get on top of something like this. It's going to be quite wide in its impact. Pharmaceutical companies, which have also come under a lot of pressure, I think the pressure is going to be eased off them. The Bernie Sanders, the Elizabeth Warren, even Donald Trump, about drug prices. Simply that we need those drug companies. Why? Because we need their research and development. We don't only need them to go into the popular diseases, we need them to go into all other diseases as well. So I think from big pharma is going to re-emerge, but it's also going to embrace diagnostics. It's going to embrace technical equipment. It's going to embrace all areas of health. I think the one area as well, the fact that it can take 7 days to have a test is just crazy. Should this break out again, or should we have various outbreaks in the future, you're going to make sure that your testing equipment can handle vast crowds or huge amounts straight away, that you don't have to, and you can get an immediate response. So we see this as a big area of investment as well, and we're not ignoring it. Just to end off as well, I think other themes, because I don't want to make it that we're only investing in tech and in healthcare as well. But you've got emerging, you've got the Asian economies doing pretty well. They're coming out of this, they're starting to grow, and I think you're getting a middle class in Asia that is getting richer. It's particularly young, it's well educated as well, and we can't ignore their spending patterns as well. That's why I still like luxury. I still think they're aspirational. I like companies like L'Oreal and Estee Lauder because it seems to be a big hit amongst them to go for the big brands, skincare and so on. So we haven't completely ignored that as well. And the last theme as well, which is also massive as well, is the growing climate change and the growing need to have clean air. And I think it's going to come with this frustration over health as well. I think the demands to behave yourself properly for countries to behave themselves and to ensure that their kids have got cleaner into the future. I think it's going to be a big subject as well. So, we've got to focus on that as well. It's going to change habits, and it's going to spend. It's also going to influence spending choice. So, just to conclude, there is a huge amount of uncertainty that we're facing caused by the pandemic. Our lives have been turned upside down, whether it's business, social, and family. At this point, there is no cure. There is no vaccine. A lot of money is spending there, but we haven't got the cure yet. But we are learning more about the virus as each day goes by. We're spending large amounts, and somewhere along the line, we will find a cure. In the meantime, economies are opening up slowly. Markets have improved. And we're learning to live, with the issue and adjust our lives accordingly. I think on the positive side, as I mentioned, the pandemic has accelerated the data economy, and this is throwing out huge number of opportunities. Of course, I say this with not ignoring that there still are risks ahead. I'm going to leave it there now. We've got a lot of questions. I'm going to rattle through. And if Nick wants to handle any of these, he's welcome to. I think a lot of them have gone. I wrote down some of the questions that have been asked. Some of them are. Errol, do you want to come in here first before I go into the questions?
Well, David, I thought I'd maybe just help you. I mean, looking at a lot of the questions coming through, I've been grouping them together, and I thought it might just be useful for me to, in terms of those groupings, maybe we can put some of them together and cover some broad themes. If that's all right?
I'll leave it to you. Sure.
Okay, great. Well, obviously the first one that you're going to get every time, and I don't think we've had a single webinar that hasn't had this question, is obviously the rand. Where do we see it going from here, medium term, end of the year, etc.?
Well, you see what happens. You see what happens when markets improve. When markets improve, the rand improves. What happens is that gold has been going up. Copper's been going up, iron ore is strong. That's really on the back of China, and that's drawing attention to emerging markets. As I mentioned, Asia's coming out of the pandemic before everybody else. Economies there are starting to pick up in a good way. The middle class is rising and so on. So there's a view that emerging markets are on the mend or will do better. And of course, as soon as that happens, people go to the rand, because the rand, regardless of where we are, is a proxy for emerging markets. So if you think these markets are going to continue upwards, and I'm talking the S&P, the NASDAQ, and global economy, and global markets are going to pick up, the rand will improve. As soon as we go into a slump, the opposite will happen. So I would imagine that the rand will continue to pick up with markets. So yeah, if you're bullish on markets, you're bullish on the rand.
And just to add to that, David, I think also on top of that, I think that we're going to see some more easing from the Fed, which might weaken the dollar a bit. So I think we might see a little bit more strength in the rand, but certainly it's not by our own doing that the rand is strengthening. It's just the global picture that's driving what's happening here.
Good point. Yeah, the dollar is under a bit of pressure now, and I think we're going to hear from a lot of economies more. EU, I think, is going to release a package as well today. This week. I don't know about the UK, but expect more packages. That's great for equity markets. I'm not going to complain. We can worry about it. At my age, I don't really care about the youngsters. So, it's Nicholas's problem. It's a millennial's problem of how they're going to get out of all these.
Leave it to us to figure out.
Jens, then I've got a few sort of, let's call them general market questions. So I think the typical ones. US stocks appear to be expensive relative to average PEs. Asking if this is a red flag. Another one about tech stocks have been leading the market rally. Is it sustainable? Question mark. Potential bubbles, and also any chance of experiencing a second wave of corrections like we saw in March. So I think all of these questions are sort of related to the rally that we've seen post the correction in March, the tech stocks driving that, and the sustainability of this.
Look, as long as I've been in markets, there's always corrections. There's always going to be a period where the market corrects. But I think what will correct the market is if this lingers. In other words, if we don't get out of it fast enough, and that's why I'm saying the results that are going to come out now are very important. The earnings seasons and what happens after that. But I think what's going to happen if we do start to fall back, I think you're going to find more and more stimulus coming through from from central banks. They don't want to go into a recession. They don't want, by recession, it's, there's a technical recession that we're going to get now brought about by governments locked up, but you don't want to go into a depression or anything like that. But I don't see it. I think the markets are pointing in the right direction. I'm going to ask Nick just to look up some of the multiples that we see in tech shares, but this is not tech bubble 2000. These companies generate huge amounts of cash. The companies that we see are massively strong. And what happens is they're going to get stronger. I know it irks those people who want to introduce regulation on Facebook, and we hear it all the time, or on Google or on Amazon, want to break up their power. But I don't think this is the right time. They're generating a large amounts of cash, and thank goodness for businesses like this that are on the opposite side, that they don't need help or they don't need first aid. From their multiple point of view, yes, they're high, but they're not astronomical. And you've got to read it against negative rates in Germany or negative rates in Japan or virtually zero rates in the US. So you've got to read it against that. I think from traditionally, if you want to use all kinds of measures, I think the premium that these companies are trading on relative to interest rates is not that high. Nick, come on, you're a technical man.
Without going into too much detail on making this a CFA webinar, the forward multiples on shares at the moment are pretty meaningless, to be honest. And that's because the earnings of these companies have fallen off a cliff in most cases. So what's happened is your PE now has shot through the roof because you've got no earnings there. So a PE multiple isn't actually a very true reflection at the moment of valuation. I actually came across an interesting article on Bloomberg where they correct the PE multiple for the amount of liquidity that's been injected into the market. And on that basis, the market is actually, I'm talking from a global perspective, so not looking at any one market in particular, that the market is actually pretty fairly valued with where it's been in the past. If you take into account, as you say, all of the stimulus that's been put into the market. So we by no means saying that the market is cheap. There are a lot of shares where we would not be adding to at the moment, but at the same time, there are shares that are also playing into these themes, these long-term themes that are actually not too expensive.
We always say, buy when it's high, sell when it's higher. So don't be scared of this market. Don't talk it down, rather talk it up.
Yeah, thanks. Quite a few questions coming through for Asian markets here. So, someone asking for our thoughts around the new Satrix MSCI China Index, and any sort of long-term views around there. Also, others around. We speak about Tencent, obviously, because of the process and the Naspers connection. But what about the other sort of Eastern ICT vendors and players out there, particularly Alibaba making inroads into cloud, etc. So quite a few other questions as well, specifically around Asia, Asian tech, etc.
I'm first in line for this. For the Satrix products, for this, I think it's a wonderful product. It's made up of Tencent and Alibaba. I think that makes up 32%. But you're getting Ping An, which is their insurer. You're getting a lot of their, the construction bank. The other one is JD.com, which is another e-commerce company. So I think it's made up of some very good business. Baidu, which is their Google. But there's a very good article in this week's Economist about other e-commerce companies in China or in that region. that are worth looking at. I'm very nervous because when I was doing CA, people used to say to me, just be careful of Chinese bookkeeping. It was a bit insulting, but remember, I did my CA in about 1970, so we weren't PC in those days. But so when it comes to Chinese booking, I really don't understand it, and I'm a bit nervous of businesses that haven't really been tested. But I think be careful of going too deep into businesses that you don't understand. But where they've forged a record, where they've forged some kind of track record, by all means. But I must say, I'm enticed to go into the Satrex product.
I think it is a very good option as an investor on the JSE if you don't want to take your money offshore.
Yeah.
A few just quick local questions, if I may. One was specifically thoughts around healthcare shares locally.
I'm a bit nervous. I'm a little concerned about the pressure on healthcare companies. We've probably seen the worst of them, but I think they're battling along in very different, in a very difficult environment. I know that also one of the points is that without elective surgery, we always look at Alec Abraham's the man who should be answering this. But we always look at healthcare companies or the hospital groups virtually like hotels. They need to occupy people. You need people in the theaters, and there's been quite a bit of competition coming in from either daycare, from those kind of areas. Which have been challenging their operations, literally their operations as well. And I think also at the moment, without elective healthcare, which is big margins, and you need to occupy beds, I think that's also taken them down a bit. So I'm not an authority on this area, but there's nothing there that's attracted me in. Nicholas, while I'm doing this, you're supposed to be reading up and helping me. You're just staring there blank, like you should have been phoning a friend, Alec, to answer this one. I think we've been hurt badly on there. There's nothing, they might be at low levels there, but I'm just kind of indifferent to them at this stage.
All right. This question, I suppose, had to come up. Tesla, specifically. We were joking about it earlier. Been a crazy mover. Maybe, Nick, do you want to start with some thoughts around that?
This is a tricky one. There's no doubt that it's a fantastic company, and what they're doing is phenomenal, and they are the clear leader in the space. In terms of whether to buy the share now, I'm a little bit hesitant, to be honest. I think that there's been a lot of, this is one where I think there's been a lot of retail hype. So as I said in my part of the presentation, with millennial investors coming in and going onto trading apps like Robinhood, when they see a share like this going up 100%, what happens is, you get more and more investors piling into it. And now all of a sudden, in the space of, a couple more weeks, we've gone from being 100% up this year to being 250% up this year. So I think at this stage, I think there's quite a lot of risk to buying Tesla at these levels. But in terms of the electric vehicle market and what they're doing, the clear leader, Musk is a bit loony, but he definitely knows what he's doing, and I think all credit to him.
Yeah, we can only wish for a Tesla, but before we can get Teslas, we have to get electricity. So from a South African point of view, it's something that's never going to come here. But they're beautiful motor cars. They are beautiful cars. I've seen in my travels, I've seen some many of them, and they're becoming particularly popular with a certain it's a status symbol, I think, and it also puts out a message there. But I'm with Nick. I think that just be careful of buying them at these levels at 1550. I mean, this is crazy. We celebrated when they went through the 1,000 mark, which wasn't too long ago. I think it was only a couple of weeks ago. But it's been a crazy run. The only problem is, John Maynard Keynes used to say, markets are irrational. The problem is that they remain irrational longer than you can remain solvent. So don't try short it, but just watch it. It's fun. I love shares that go like this. We had Beyond Meat, we've got Zoom. All of them are going in this kind of direction. So I prefer shares that go up 10 times to those that go down 10 times. And I think we've got many of them on our market here.
Yeah, probably an element of short covering in that stock as well. I've seen Musk taunting all the short sellers on Twitter all day for the last few weeks. We're almost out of time. I think there's just two additional questions I would like to spend a little bit of time on. The first one is quite a few people asking about gold, where we are right now and whether we should be getting involved. Let's start with that.
Yeah, I think with interest rates 0 or -0, whatever they are, -1, it's obviously it's going to benefit gold. And also with the fear factor that's in the market at the moment, gold is going to attract a lot of investors. The direction is upwards, and you're not going to stop that. It's gone through 1800. I think in 2011 we reached 1850. It'll probably somewhere down the line breach that. It's certainly a safe haven. And of course, as long as gold goes up, it's going to help gold shares. Gold shares have had a tremendous run, but it is an area. I'm not a gold bull, even though my dad was probably the biggest gold bull the J's ever seen. And I'm not a gold bull for the simple fact is that I like to hold companies that produce something. So that's just my nature, but I'm not knocking it. I mean, if I would have bought gold shares, I would have been a lot richer than I am now. I would have been, that doesn't mean I'm rich. I mean, I would have been richer than I am now. You know what I'm getting at? Or our clients would have been a lot richer than they are. But you can't ignore it. We missed it. And I think that in the current trend, gold shares are going to go better. That's it. If you want to go along for the ride, sure. But when things start to recover, that's when gold goes the other way. Because when things genuinely recover, then interest rates start to go up. The cost of holding gold starts to become expensive, and that's when you start to find people switching out of gold for other instruments. Looking for yields and that. But that could be years away. We're not going to see interest rates go up for years. So that favors gold.
I think, Dave, just on that, I think, when gold turns, it turns quickly. And so, if you go into gold now, you might still actually, there might still be gains ahead. And I think, as you say, for those points, the gold price could head higher. But when things turn and gold isn't in fashion anymore, it's going to drop quickly. And then it's going to be a question of, how quickly can you get out?
Yeah, you've just upset the gold bulls, Nick. We've just had them on our side. Do you know that?
Last question, David. I think specifically for you. Just saw a comment come through that last month when we hosted a webinar, we were saying, look, don't rush in. Where do we stand right now from a timing perspective? Has anything changed over the last month?
A lot has changed. The market's gone up. In other words, don't ignore that. What the market's telling you is that confidence is returning, and that was an indicator. That was a trigger. We were nervous about the direction of the market. It wasn't that we ignored, that we just said hold back. We just said don't rush in, just wait and see what happens. And that's why I'm saying the signals that are coming now are a lot more positive. We get, as I mentioned, we're getting on top of the pandemic. We're learning more about it. We're learning a lot more than we had a month ago. So I think from that point of view, I feel a lot more confident about taking advantage of where we're at, even if we are paying a lot higher than we would have, say, a month ago. But that's market. So I prefer the direction of where we are at the moment. So, yeah.
Okay, thank you very much. Thank you, David. Thank you, Nick. I think that's all we have time for today. Thank you for your insights.